In this video, I'm going to be walking through the 3-bucket retirement income plan and how it works and how you can implement this to ultimately help you succeed in retirement. But first, my name is Jacob Duke. I haven't met you yet, and I'm a certified financial planner, and I help people just like you retire. And the purpose of this channel is ultimately to help you learn and grow. That way you can succeed in retirement. So let's go ahead and jump into what the 3-bucket strategy is and how it works. Now, I know that there's so many different ways to think about how you can plan for your retirement income and different strategies and ways to do that. But the one that I prefer is going to be the 3-bucket strategy because I'm a visual person. I enjoy seeing something and then making sense of it mentally that way, as opposed to conceptually, if someone just tells me something, it's hard for me to remember it. So whenever I think about how I can simplify my retirement plan or my financial plan, that leads me to saying, hey, well, the 3-bucket strategy helps me do that, because ultimately what we're doing is we're siloing or sectioning out your dollars. If you have $1 million, let's say, you're sectioning that out to actually be particular asset classes. So that means cash, bonds, treasuries, CDs, or equities like stocks. So that's kind of what it is. You're saying this bucket does this bucket does this, and this bucket does this. So here you can see that I do it in a 3-bucket way, and we've got cash, we've got bonds, and we've got stocks. So those are the 3 primary asset classes that you're going to find in anybody's portfolio in terms of retirement planning outside of real estate, which is I guess a different topic or discussion. But for normal investment types, cash, bonds, and stocks, I like to bucket them out based on how much money we need to have in each. And we're about to walk through what that is. But first, I want to actually explain what is cash, what is bonds, and what are stocks. So I want to make sure that we have a good understanding of that first. Now, cash can be anything that's in your bank account. So savings, checking, it could be high yield savings accounts, it could be money markets, or it could be CDs that are 6 months or less. Now, if all of your money is wrapped up in a 6-month CD and you call that your cash, well, it's not really cash because you're gonna have to pay a penalty to get to that money. So you need to have obviously money in your savings or checking account. And then if you want to have a CD that's 6 months or less, you can also have that and count it as cash too. We also have bonds, which consist of corporate bonds, like you have Apple or Google has a bond that they issue. You could buy that. You have bond funds through mutual funds or ETFs. Those are corporate bonds. You can also have treasury funds. You can also have CDs that are 9 months or longer. I like to think of those as bonds simply because of the time frame. And then you also have municipal bonds as well. So that's your bond bucket and kind of what falls into that. And then you also have your stock bucket, which could be individual stocks, it could be stock ETFs, it could be stock mutual funds, or just for simplicity, I want to throw REITs into this bucket as well. I know it's real estate, but in terms of volatility and how they operate, they're more like a mutual fund than they are like an actual bond. So that's kind of the 3 sections of money and how we're going to silo this out. Now, how much money do we want to have in each bucket? That's really the question that we're looking at. So the way that I like to do this is it's ultimately saying, instead of deciding to have a 60-40 or an 80-20 portfolio for your retirement, I like to say, how much money do you need every single year in terms of how much you're going to be spending or how much expense needs you have? And then we want to multiply that by a certain number to reach how much we can have for that number of years. And then want to allocate certain dollars for that amount of time. So for example, I like to have at least 2 years of living expenses in cash that's readily available. So that could be cash, high yield savings, it could be money market, or like I said, a 6-month CD or in that range. So I want to have at least 2 years. Sometimes it can be from 2 to 3 years. The next bucket is going to be bonds, and I like to have 3 to 5 years of my living expenses in bonds. And this can be anywhere from treasuries, corporates, it could be spread out from short-term, mid-term, long-term. Regardless, this is your mid-term bucket of money. Like, you don't need any of those dollars until 3 years from now. And it's going to last you from years 3 to 5 from now at least. So that's why I want to do it that way, because those are going to produce more interest and dividends that are going to be coming to you in terms of income, but they're also not the stock market. So they have a little bit more risk, but not quite as much risk as an equity. And then the final bucket, that's going to be stocks. That's going to be a very important bucket in all of this, because we need to have money whenever we're 85 and 90 and 95. And that bucket is going to be growing at a greater rate, hopefully, than inflation. Historically, that is the case. Who knows what the future holds, but that's what we're counting on in that regard. So the purpose of doing it this way is we've got at least 5 years of living expenses in cash and bonds, which means that if the stock market goes down in the first 2 years of your retirement, yes, that could be something that is a detriment to you. But if we plan it out correctly on the front end, then we actually get to have a window of time that regardless of what the stock market does, you're going to be okay. And so the reason I like this bucket strategy is because you can visually see this and say, yes, my stock portion of my money went down, but my cash is still here and my bonds for the most part are still here and they're still giving me my 3, 4, 5%, whatever it is at the time, rates of return in terms of a yield. So we can withstand 5 years of market downturn. And the reason I like to use 5 years at least as a minimum is because 2008 was the largest event we have in recent history, because it went from 2007 until 2013 before we could really get back to where we were in the stock market before '08 happened. So that's why I like to use that 5-year time frame, and that's how I like to bucket out my money in terms of how much I want to have in each bucket. So right here you can see that I like to think of my cash bucket as my short term. Got that? We've got our bond bucket, our treasury bucket, that's going to be our midterm, and then the long term stocks is going to be the third bucket. So each of these is very important. Like, we can't have all stocks, we can't have all bonds, we can't have all cash. They have to work together correctly because each different time period presents its own risks, right? If we're 100% stock because we're like, oh, I can withstand market volatility, well, as soon as the market goes down 30% and you still need to draw income from your portfolio, you're selling at a discount, which means you're never going to get to recoup the 30% you lost. And so that's a risk in the short term, which is why we have that short-term bucket of cash. On the back end, if we only invest in cash and bonds and money markets and CDs because we're scared of volatility that happens in the market from day to day, well, whenever you get to age 80, 85, 90, you could run the risk of running out of money because you have not been beating inflation throughout your retirement. So there's risks on the long term and there's risks in the short term. We've got to cover both, and that's why I love the bucket strategy, because it does just that. Now, when we think about which accounts we have, sometimes we have IRAs, we've got Roths, we've got brokerage, we have different account types. We've got 401ks perhaps. I like to think of these as the same. Regardless, whenever we think about the bucket strategy, how do we do that within each account type? Well, just for a quick rundown and almost an aside, I want to make sure that all of my stocks or my equity holdings, like equity ETFs or mutual funds, I want to have all of those, if possible, in my Roth accounts, and then I want to have those in my brokerage accounts. And here's why. Any dividends that you receive from your stock funds, they qualify for long-term capital gain rates if you've held the fund for a certain amount of time, being 60 days or longer. There's a little more nuance to that, but if you hold the fund or if you've purchased it at least 60 days ago, the dividends that are going to come in are going to be qualified. Also, whenever you sell that fund and after you've held it for a year, you qualify for long-term capital gains at that point as well. So all of this to say, we want to have that money in our brokerage account if and when possible. And then also we want to have our stocks in that Roth account because that Roth account's growing tax-free and stocks are going to grow more than any other asset class. So we want to have it in those two accounts for those two reasons. We want all of our bonds, we want those in the IRAs, which are tax deferred, and then we want them in our 401ks that are tax deferred. Now, it's not going to line up perfectly because most of the time people have a large portion of their retirement savings in those tax deferred IRAs and 401ks. But when possible, I don't want to hold bonds in my taxable brokerage account nor in my Roth IRA for the two reasons I explained earlier. And obviously cash or money markets, you want to have those in your 401ks or IRAs or just in your bank account. Right? So that's how you want to section that out. So every account is not going to be invested the exact same. So for example, if your overall portfolio allocation is 70-30, well, each account type, brokerage account, Roth IRA, and traditional IRA, those are not going to be invested 70-30 in each one, or they shouldn't be from an asset location and optimizing your taxes standpoint. So each bucket is going to be made up of different accounts. And like I said, these are not going to align properly or exactly right. So you might have stocks in your IRA, you might have stocks in your brokerage, and then you also might have it in your Roth, right? So you could have stocks in all of those. Like I said earlier, we probably will have bonds in our IRAs, and that's maybe it. Because a lot of times like I said, our IRAs are going to be our largest account types. If we do have money markets or things like that, sometimes that will be in a brokerage account because we need to access it to pay Roth conversion taxes or just have living expenses that are, quote, after tax. So we could have that there, or if we want to have that obviously in the bank or an IRA because that's more tax beneficial there. So not all of this is going to line up exactly right, which means you have to figure out, hey, which accounts are my stocks and bonds going to be in and in which allocations. Now, one thing I did want to point out and kind of show you is how I do this with my clients. I actually build this and send this quarterly, but this is an example retirement buckets kind of one pager that I send out. So what we have here is we've got our cash, we've got our bonds, we've got our stock buckets, all right? And these are the current amounts in each of those buckets. And we've got target amounts as well. So based on their spending, let's say it was $125,000 per year that they need to spend. That means that $250,000 is going to be in cash. That means that $550,000 is going to be in bonds, or perhaps maybe just a little more than 3, maybe 4 years could be there. And then the rest of it is going to be in their stock portion. So what we can see is that they actually have more than they need in cash based on their current spending amounts. And they also have more than they need by a little bit in their bond account or in their bond bucket because of their spending. And so we can see that long-term, their long-term money, their bucket number 3, their stock bucket, that actually presents a risk. So a thought that comes up to me here is, hey, Mr. and Mrs. Client, what if instead of keeping all that cash right there in your bank, what if we started slowly dollar cost averaging over into your stock bucket to help eliminate the risk of inflation long term? So this is something that I want to keep track of every single quarter because these are all changing with the market. So maybe the market just went down this quarter, which means we were up here at say $1 million and it went down to 900,000. Well, that might not mean that we need to change anything here, but it also does present a buying opportunity to go buy at a lower price. So we have cash to deploy. What if we went and did that? So this is the 3-bucket kind of retirement planning strategy that I like to use in terms of how much money we need, and then ultimately leads us to here's how our investment allocation lines up to that. So I hope this has been helpful, and if it has been, go ahead and like the video, subscribe, and then share with a friend. And other than that, I look forward to seeing you next time.